it's not directly related to tomorrow's jobs report, but the number of people filing for first-time unemployment benefits ticks up a significant amount given where we are, up to 200,000 from 185,000 the prior week. So a 15,000 gain now. That's statistically insignificant, basically, but it does tell you that there are still people who are, for one reason or another, looking for unemployment insurance. But as I said, this was not the reference week for jobs, so tomorrow's numbers aren't going to be affected by this. The other number that is out today that is bad news is non-farm productivity, down 7.5% in the first quarter. That is from a 6.3% gain in the fourth quarter. And it just shows you the swing in GDP made a big difference in productivity. Unit labor costs rise 11.6% after rising 1% in the fourth quarter. And let me just check here. That is the most since since 2020, which of course is going to be because of the pandemic. But I'll have to see what the lowest, rather the highest that is in terms of unit labor costs before that was. You probably have to go back
2014.
to 2014. So at this point, it looks like companies are paying up and getting less for it. At least they were in the first quarter.
Right. Mike, let's get a clinic on that while you were yammering away there. And it's really hard for Mike McKee to do this, folks, with the headlines coming out. I went to unit labor costs in a fancy chart here. And basically, the longer-term moving average of unit labor costs, Michael McKee, get us back to the early 1990s. What does that signal about wage inflation that we may see tomorrow?
Well, the numbers suggest that we probably will see continued wage inflation. Also, the fact that the unemployment rate is forecast to tick down to 3.5%, and we may not see a lot of gain in the labor force. So we are expecting wages to go up. Jay Powell said the labor market is extremely tight. But you want to go back to the 1990s. What happened then was Alan Greenspan raised interest rates by 300 basis points, and we did not have a recession. Instead, we got a very long, very strong expansion. So I guess there's two paths that we could follow from here.
Payrolls on Friday, tomorrow, Mike. On to CPI next week. Just looking at one of the estimates from Morgan Stanley, 8.1%, down from 8.5. Then you get into core and the month-over-month figures too. Mike, away from payrolls into CPI next week, what's the focus for you?
Well, it's going to be the core rate because we know that we're going to see energy and food price pressures continue, especially with what's going on with Ukraine and Russia. So is the core rate slowing down? We saw that in the PCE numbers last week, the Fed's favorite indicator of inflation. And if the core rate is moderating, that would give the Fed some hope that their interest rate increases would have an effect. But we also want to look at what housing is doing, because that's going to take a long time to come down, and it has added a lot to price pressures in CPI.